In this month's edition of Accounting News, we're looking at some specific scope exclusions from AASB 17 insurance contracts. So up to this point in time, we've been looking at the definition of an insurance contract, and therefore implicitly a lot of those contracts would be within the scope of AASB 17. In this month's edition, we're looking at those contracts that might actually meet the definition of an insurance contract, but the standard setters have specifically scoped them out of the standard. Now, standard setters will from time to time include scope exclusions from certain standards, and the main reason for this is to, when dealing with contracts or transactions or other events that may fall within the scope of more than two accounting standards, the standard setters trying to reduce the prospect of diversity in practice will specifically state that a particular transaction, contract or event might fall within the scope of that standard. And a good example of that is a financial guarantee contract. Now, a financial guarantee contract is one where an entity will compensate another entity for a credit loss they've made in respect to the counterparty to a debt instrument. And in that situation, there is an insurance component, but the standard setters decided early on that because the nature of the arrangement is very much focused on credit risk, then it would be best to have that particular type of contract within the scope of AASB 9 financial instruments, as opposed to, say, AASB 17 insurance contracts. In response to feedback from constituents, the IASB amended the scope of IFRS 17 to clarify that with regards to a loan that might be otherwise within the scope of IFRS 17, could be within the scope of IFRS 9, provided that the insurance component was only to the extent of the unpaid balance of the loan of that contract. The IASB also clarified the scope of IFRS 17 to exclude those credit card arrangements and other similar contracts that might otherwise meet the definition of an insurance contract, could be scoped out of the standard, provided that the pricing of that contract is not reflective of the individual cardholder's insurance risk. Now, both of these scope exclusions are really important to non-insurers because they have the potential to push those particular contracts out of the scope of IFRS 17 and into the scope of another standard.